Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trow, TPSU, and 401k TV. I review all of last week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, a PwC survey with senior executives told two stories about a cooling job market that is still red hot based on July job growth. Half of these executives responded that they were reducing their workforce, and 52% have a hiring freeze. And for those that are hiring, 40% have rescinded offers or are reducing or even eliminating sign-on bonuses. Yet many are still boosting pay, especially for highly skilled jobs like tech workers, and are increasing benefits and allowing people to work remotely, although 61% are requiring employees to come into the office at least occasionally. Next story, with the 12th deal of the year, Creative Planning CEO Peter Mallouk indicated that things could slow down after acquiring Whipfly, a $5 billion RIA with $1 billion in retirement assets that was part of a much larger CPA firm. In November 2021, Creative Planning had just $100 billion and now boasts $225 billion, mostly due to the $100 billion acquisition of Lockton's retirement division. Mallouk said he is passing on 97% of the deals that he sees, indicating perhaps that we may be seeing a buyer's market emerging. Either way, Creative Planning has eclipsed all the other RIA aggregators, hoping to leverage the convergence of wealth, retirement, and benefits at work. Next story. Affirming a September 2020 $1.5 million sanction against the Schlichter and Schneider law firms. The federal court cited unreasonable conduct and reckless disregard of duty in a case filed against Empower and Great West. Though the onslaught of lawsuits against 401k and 403b plans continues, with smaller plans and RPAs likely to be the next target, these sanctions could make some law firms more cautious. Next story. In joint research by DeCia and Commonwealth, results show that emergency savings plans at work could result in less debt and decreased tapping of retirement accounts and other financially detrimental actions by lower paid workers. The attributes favored by these workers include no fees, no minimum balance, and fast access, as well as employer incentives. The lack of emergency savings could inhibit participation in retirement plans. Though not in the research, emergency savings could eliminate the need for loans, which could incent record keepers to offer this new feature even if they cannot make much additional revenue. And with that said, Alera recently announced a payroll deducted option to their emergency savings option. Finally, in last week's RPA Edge column, I argue that lawsuits against smaller plans and RPAs are inevitable, with copycat complaints easy to file and lawyers hoping for a quick settlement. This week, I outlined how RPAs can help clients protect against these lawsuits, though RPAs themselves have become more attractive targets through acquisitions and offering proprietary investment products and participant services. So those were the most important stories from the past week. I listed a few others I thought were worth reading, Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk.